The Intelligent Investor by Benjamin Graham. The Intelligent Investor is a widely acclaimed book on investing written by Benjamin Graham, one of the most influential investors of the 20th century. The book was first published in 1949 and has since been updated and revised several times. Graham's main thesis is that successful investing requires a disciplined and patient approach, focused on fundamental analysis of companies, and a focus on long-term returns. He also stresses the importance of diversification, risk management, and avoiding emotional decision-making in investing. The book is divided into two main parts. The first part discusses investment principles and strategies, while the second part focuses on analyzing individual stocks and bonds. Graham's ideas have influenced generations of investors, including Warren Buffett, who has referred to him as his mentor and cited The Intelligent Investor as one of the most important books he has read on investing. Chapter 1: Investment versus Speculation. Results to be expected by the Intelligent Investor. Chapter 1 of The Intelligent Investor by Benjamin Graham is titled Investment versus Speculation. Results to be expected by the Intelligent Investor. In this chapter, Graham introduces the idea that investing is different from speculation, and that the intelligent investor should focus on investing rather than speculating. Graham defines investment as the process of purchasing assets with the expectation of generating income or profit in the future, while speculation is the process of purchasing assets with the expectation of making a quick profit based on market trends or other short-term factors. He argues that investing is a more reliable and sustainable approach to building wealth than speculation, and that the intelligent investor should focus on the long-term performance of their investments rather than short-term market fluctuations. Graham also stresses the importance of risk management and diversification in investing, stating that the intelligent investor should not put all their eggs in one basket and should spread their investments across different asset classes and sectors. Overall, the main message of this chapter is that the intelligent investor should focus on investing rather than speculation, and should prioritize long-term performance and risk management over short-term market trends. Chapter 2: The Investor and Inflation. In Chapter 2 of The Intelligent Investor by Benjamin Graham, titled The Investor and Inflation, Graham discusses the impact of inflation on investments and provides guidance for investors to protect themselves from its effects. Graham explains that inflation is a decrease in the purchasing power of money over time, and that it erodes the real value of investments such as stocks and bonds. He also notes that inflation can be unpredictable, making it difficult for investors to plan for its effects. To protect against the impact of inflation, Graham recommends that investors focus on investments that have the potential to provide a hedge against inflation, such as stocks of companies that are expected to increase their earnings at a rate greater than the rate of inflation. Graham also advises investors to avoid long-term fixed-income investments, such as bonds, that may lose value over time due to inflation. Instead, he suggests that investors consider short-term, high-quality bonds or bond funds, as well as inflation-protected securities. Overall, the main message of this chapter is that inflation can have a significant impact on investment returns, and investors should be aware of its effects and take steps to protect themselves through careful investment selection and diversification. Chapter 3: A Century of Stock Market History. The Level of Stock Prices in Early 1972. In Chapter 3 of The Intelligent Investor by Benjamin Graham, titled A Century of Stock Market History, The Level of Stock Prices in Early 1972, Graham examines the historical trends of the stock market and the levels of stock prices at the time of the book's publication. Graham notes that over the past century, the stock market has experienced significant fluctuations, including major booms and busts. He emphasizes that these fluctuations are a normal part of the market's behavior and that investors should be prepared for them. Graham also analyzes the level of stock prices in early 1972, noting that they were high by historical standards and that the market appeared to be overvalued. He warns investors that such high valuations are often followed by periods of market decline and advises caution in their investment decisions. Overall, the main message of this chapter is that investors should be aware of historical market trends and the current level of stock prices, and should avoid being overly optimistic or pessimistic in their investment decisions. Graham emphasizes the importance of a disciplined, long-term approach to investing, and of being prepared for market fluctuations. Chapter 4, General Portfolio Policy, The Defensive Investor. Chapter 4 of The Intelligent Investor, by Benjamin Graham, titled, General Portfolio Policy, The Defensive Investor, outlines the investment approach that Graham recommends for investors who prefer a more conservative and passive approach to investing. Graham introduces the concept of a defensive investor, who is primarily concerned with preserving their capital and minimizing risk. He suggests that defensive investors should focus on investing in a diversified portfolio of high-quality, large-cap stocks, bonds, and cash equivalents. Graham recommends that defensive investors allocate a significant portion of their portfolio to bonds and cash equivalents, which provide a stable source of income and help to reduce overall portfolio risk. He also advises defensive investors to avoid speculative investments and to maintain a long-term investment horizon. Graham provides specific guidance on portfolio construction for defensive investors, suggesting that they invest in no fewer than 10 different stocks and no more than 30, and that they allocate between 25% to 75% of their portfolio to stocks, depending on their risk tolerance. Overall, the main message of this chapter is that defensive investors should prioritize risk management and diversification in their investment approach, and should avoid speculative investments. Graham provides specific guidance on portfolio construction for defensive investors, emphasizing the importance of investing in high-quality assets and maintaining a long-term perspective. Chapter 5, The Defensive Investor and Common Stocks. In Chapter 5 of The Intelligent Investor, by Benjamin Graham, titled, The Defensive Investor and Common Stocks, Graham provides guidance for defensive investors who are interested in investing in common stocks. Graham begins by emphasizing the importance of a long-term investment horizon for defensive investors, as short-term market fluctuations can be unpredictable and may lead to poor investment decisions. He also stresses the need for defensive investors to focus on investing in high-quality, large-cap stocks with a long history of stability and profitability. Graham provides specific guidance on how to identify these high-quality stocks, suggesting that investors look for companies with a strong financial position, a history of consistent earnings and dividends, and a long track record of stable and growing sales. Graham also emphasizes the importance of diversification in a defensive investor's portfolio, recommending that investors spread their investments across different sectors and industries to reduce overall portfolio risk. Overall, the main message of this chapter is that defensive investors should focus on investing in high-quality, large-cap stocks with a long history of stability and profitability, and should prioritize diversification and a long-term investment horizon. Graham provides specific guidance on how to identify these types of stocks, emphasizing the importance of a company's financial position and track record of earnings and dividends.